Alphabet just posted a massive 19% jump in net income year on year, blowing past Wall Street expectations. And what's powering this surge? It's their aggressive push into AI and cloud services. But is this sustainable growth, or just hype before the real challenges hit? In today's video, let's break down what this means for Alphabet, Google, and your investments. Now, for those who might not follow tech stocks daily, Alphabet is the parent company of Google. It owns not only the Google search engine we use every day, but also YouTube, Google Cloud, Android, Google Maps, and Waymo, its self-driving tech arm. Alphabet was created in 2015 as a holding structure to separate Google's core businesses from its more ambitious moonshots. Today, it's one of the world's most valuable companies, trading under the ticker symbols GOOGL and GOOG. Let's dive into their latest earnings report, which sent the stock up after release. Alphabet reported net income of $23.6 billion, up 19% from last year's $19.8 billion. Total revenue came in at $84.7 billion, an increase of 14% year on year, again surpassing consensus analyst estimates. Earnings per share, EPS, stood at $1.89, higher than the expected $1.84. Now, breaking this down by business segments, Google advertising, this remains the core engine, contributing around $65.5 billion, up 12% year on year. YouTube ads also saw a healthy 16% growth. Cloud revenue rose to $10.1 billion, up 25%. This business is now profitable for the fourth quarter in a row, with $900 million in operating income. Other bets, still small, bringing in just $300 million, but losing $1.2 billion, mostly from projects like Waymo and Verily. The beat reflects cost discipline and strategic investment in AI and cloud infrastructure. Alphabet's management emphasized that AI is at the heart of their growth strategy. The rollout of Gemini, their next-gen AI model, across Search, Google Workspace, and developer APIs, is already boosting user engagement and enterprise adoption. For example, Google recently integrated Gemini into Gmail and Docs to enhance productivity with summarization, content drafting, and advanced search capabilities. This positions them as a key competitor to Microsoft Copilot. On the cloud side, their Vertex AI platform allows businesses to build and deploy custom AI models efficiently. This has driven growth in AI workloads across healthcare, retail, and finance. Demand for AI-optimized infrastructure, including their TPUs and NVIDIA GPU clusters within Google Cloud, is also driving higher margins. CEO Sundar Pichai noted in the earnings call that customers are choosing Google Cloud to run their AI workloads due to its open models, cost efficiency, and integrated AI capabilities. Overall, AI is not just a buzzword. It is translating into real measurable revenue growth, particularly in cloud. Alphabet's leadership gave deeper insights into their strategic direction during the earnings call. CEO Sundar Pichai highlighted the growing adoption of AI-powered search in Google Workspace and emphasized the company's strength in building and deploying foundation models. He also stressed their competitive advantage in AI infrastructure, noting that customers are increasingly choosing Google Cloud to run AI workloads because of its open models, cost efficiency, and integrated tooling. Meanwhile, Ruth Porat, the company's president and CFO, reiterated Alphabet's focus on operational discipline, balancing long-term investments in AI with cost management. The takeaway? Alphabet isn't just growing fast, they're growing smart. While Alphabet's AI and cloud strategy is clearly driving growth, it's not without risks. First, competition is intensifying. Microsoft is aggressively expanding its AI capabilities with Azure and its partnership with OpenAI. Amazon Web Services still dominates in cloud infrastructure. Second, building and training large foundation models like Gemini requires enormous capital investment, and margins in cloud are still catching up to other segments. Third, AI regulation is becoming a growing concern. Governments around the world are starting to look at how companies collect data and train models, which could introduce compliance hurdles and increase costs. Finally, while Google Cloud is growing, it still trails AWS and Azure in market share. That gap might take years to close. So while the future looks bright, Alphabet must navigate carefully to maintain momentum in a highly competitive, fast-evolving space. Looking ahead, analysts remain optimistic about Alphabet's long-term trajectory. Continued investment in AI, especially through platforms like Vertex AI and the Gemini model family, is expected to drive enterprise adoption and user engagement. Google Cloud is narrowing the gap with AWS and Azure, and with cost discipline in place, margins may continue to improve. If Alphabet can maintain its momentum in innovation while navigating regulatory headwinds and intense competition, it's well-positioned to remain a dominant force in the AI economy. For long-term investors, Alphabet's strong balance sheet, diversified business model, and leadership in foundational AI make it a company worth watching. So, what do you think about Alphabet's AI and cloud strategy? Are you bullish on their long-term growth, or do you see risks that investors should watch out for? Let me know your thoughts in the comments. And if you found this breakdown helpful, make sure to like, subscribe, and tap the bell icon so you don't miss future updates on top tech stocks and earnings reports. Thanks for watching.